So the next module is wealth building, right? So before we start, I think it's very important that we first explain the distinction between someone who is rich and someone who is wealthy. I really want to talk about this quote by Robert Kiyosaki. He says, many people believe that being rich and being wealthy are the same thing, but there is a difference between the two. The rich have lots of money, but the wealthy don't worry about money. Take a second, process that. That might, you might think to yourself, okay, well, I mean, if you're rich, you don't really have to worry about money, right? Because I'm just like swimming in it. Why would the rich worry about money? Okay, so let me tell you why someone who is rich might have that worry, right? So you could be someone who earns, let's say, $150,000 a year, right? And if you earn $150,000 a year, that puts you in the top 5% of earners in the US. But if you have lots of expenses that keep you up at nights, things like a mortgage or a car payment, credit cards, student loans, other random bills, that's when people get stuck in what is called the rat race, right? And if you don't know what the rat race is, Wikipedia has a perfect description. The rat race is an endless, self-defeating, or pointless pursuit. The phrase equates humans to rats attempting to earn a reward, such as cheese, in vain. Take a moment, think about it, and you can begin to understand how even someone who is in the top 5% of earners in the US can be trapped in the rat race, right? Because they have to get up every morning, go to work to sustain their lifestyle, right? And the worst part of their situation is that they have to trade their time for money, right? If they don't work, they don't get paid. Now, this is fine for someone who loves their job, right? But if you don't love your job, you can feel like you're just stuck in that hamster wheel. You slowly start to despair, and over time, you just get frustrated, and as you're trying to keep up to sustain that lifestyle that you have, right? Which can lead to having financial stress again. Leading this type of lifestyle that brings along with it a laundry list of bills is a common cause of financial stress and anxiety for people. Like I said, and the rich are not excluded from this pitfall. Let me ask you another question. How much money would you need to earn annually to consider yourself wealthy? What if I said 60,000? What if I said you earned $60,000 a year? Would you consider that person to be wealthy? Yes, no. Probably not, right? But what if I said that $60,000 was passive income? Okay? And passive income is money that you do not have to trade your time for, right? So this is just money that is earned from your investments, and that's just money in your account. If you had 60,000 a year of passive income, that equates to 5,000 a month going into your bank every month, right? Without having to work, you can just sleep in all day. I don't know, play some video games or watch some TV, whatever. The point I'm trying to make is that wealth is really relative, right? So everyone has different levels of income requirements before they would consider themselves to be wealthy, right? 60K a year might not seem like a lot, especially to people here in California where the cost of living is so expensive, right? But that same $60,000 can go a long way in other parts of the world, right? So that if you don't have to work and that money comes into your bank account passively, 60K can go a long way in places where the dollar is stretched very far. Places like the Philippines, Thailand, or parts of Southern America, right? I wanted to point out that it's just really relative. Some people are not happy with that, which is totally fine. If your level of wealth would be, like someone said, $200,000, that's totally fine. The point is, it's all really relative to what your expenses are and what lifestyle you are trying to lead. So now that you know the difference between someone who's rich and someone who's wealthy, I wanted to give you the definition of wealth that I like best. And that is definition by Richard Buckminster Fuller. And he said, wealth is a person's ability to survive X number of days forward. Said another way, it's the number of days you can live without having to work and sustain your current lifestyle. It's that simple. It's not about owning a fancy car. It's not about, having the biggest house or having like the coolest and latest tech gadgets, right? So it's just really, when it comes down to it, it's how many days can you sustain your current lifestyle existence without having to work, okay? Which is why wealth is measured in time, not dollars. I want to give you guys a second to really let that sink in for a second, right? Wealth is measured in time, not dollars, okay? I know for me personally, I think as you grow older, you start to realize that what's most valuable to a person is their time, right? Because it's something you cannot buy, it's something you cannot trade, you cannot sell this, it's just oh, you could sell it, you could sell your time, sorry, but you can't acquire more of it. The goal should be, how can you situate yourself in get in the situation where you have built enough wealth so that time is what you have the most abundance of. So let's look at the road to financial freedom, which is, again, having enough passive income to cover your living expenses according to your personal level of lifestyle that you want to lead. So right now you probably are thinking to yourself, yeah, thanks a lot, George, for pointing out to me that I'm neither rich nor wealthy, you Mitch. So, but don't worry, I'm going to show you exactly how you can start your journey on the road to financial freedom. Okay, so the very first thing you need to know is the most important rule of Financial Fight Club. And that rule that you must know is, you must know the difference between an asset and a liability, and buy assets. Okay, that's the first rule. The second rule of the Financial Fight Club is, you must know the difference between an asset and a liability, and buy assets. Okay, so you must be wondering, okay, so I don't really know what the difference is. What are assets? What are liabilities? Okay, so put very simply, liabilities take money out of your pocket every month, every time you get paid, every time you get money. These are things that take money out of your pocket. These are things like your car payment, your credit card payments that you have to do, mortgages. If you have a house, you have to pay for it. And that one, it sounds counterintuitive because people sometimes think that, hey, I thought houses were investments. What's going on here? And yes, they can be. I guess it depends on your strategy. But let's say you have a house for yourself and your family, and you're paying the mortgage. What happens if you lose your job? Like, so many people are facing layoffs, and yeah, there's been provisions put in place to, like, put off your mortgage. But let's pretend that wasn't the case. If you lose your job, at the end of the day, you still have to pay your rent. Okay, so it's really, at the end of the day, it's a liability, not really an asset. Okay, and contrary to that, assets put money into your pocket, really simply. Okay, so if you own an asset, every month or every quarter, it's going to put money into your pocket. So let's look over a list of different asset types, right? These are the different types of assets that you can acquire to start building your wealth. The first one is a business that does not require your presence. Okay, number 2 are stocks. Number 3 are bonds. Number 4 are income generating real estate. Number 5 is notes, royalties from intellectual properties, and anything else that produces income. Stocks, the easiest, that's just stock market. Same thing with bonds. Those are things that you can purchase, kind of lower risk version of stocks. Income generating real estate. Notes, what notes is if you're acting as a lender. So let's say I had $100,000 saved up. Eddie comes to me and says, "Hey, dude, I want to borrow $50,000. Would you be willing to lend me $50,000, and I'll pay you interest on that money?" That is a note, right? So then I say, "Okay, cool. Here, I'll give you a personal loan. Here's $50,000. Just pay me back with 5% interest." That's essentially what a note is. Royalties are things like music, any intellectual property, stuff like that. And then the last one, anything else that produces income. Those are things like it could be things like online courses. If you are really knowledgeable on something, people put things on courses. Even like, there's people for financial courses, music courses, all sorts of things that are online. Another example are like Amazon affiliate links. So anything that produces income is considered an asset. Okay, so I know what you must be thinking still, like, okay, yeah, sounds great. Those are all pretty obvious things that you want to buy, but if I had the money to buy it, a rental property or own a business, I would have done that already, right? That's kind of where I want to lead into how you can get on the fast track to saving enough money to acquire your first asset. And it's with a vehicle you've probably already heard of, right? And those vehicles are retirement accounts. Surprise. Okay, cool. So the two biggest ones that you hear about are IRAs and 401ks. Okay. And you see the Roth egg there on the left because, again, they come in different flavors, right? So there's the traditional IRA, and then there's the Roth IRA, and then there's the traditional 401k, and then again, there's the Roth 401k. That's when you start thinking, okay, well, what's the difference between traditional and Roth? And that difference is that traditional 401ks and IRAs are funded with pre-tax dollars. And what that means is every time you get a paycheck from your employer, you have the option to contribute into these accounts before you are taxed on your money, okay? As opposed to the Roth flavors of these, when you get paid first, you pay Uncle Sam, okay, here's your cut, dude, and then the rest, whatever I have left, I can invest into my retirement accounts, right? And so that's really the difference up front and when you're contributing, right? There's also differences on the end. So if you don't pay, I mean, you can't. There's no escape from taxes, right? You can't escape death and taxes. So and Uncle Sam is either going to collect before you contribute or after, right? So if you don't contribute, if you don't pay your taxes when you're contributing in traditional ones, he's going to collect on any payments you collect once you retire, right? So if every month you're collecting $5,000 a month in retirement in your traditional IRA or traditional 401k, then he's going to count that money as your regular income, right? So then you're going to be taxed at whatever current bracket you're in once you retire. So that's kind of the difference between the two. So let's kind of take a closer look at what 401ks are. So the 401ks, they're named so because it references the 401k section of the tax code, which was enacted into law back in 1978. You know, some pros and cons of the 401ks, some pros. There's an employer match if offered. You know, a lot of companies will offer a match of whatever contributions that you put into your own 401k. There's almost always there's going to be like some sort of limit. So they'll say, okay, George, if you want to contribute, 3% of your salary into your 401k, we will match up to 3%. Anything above that, we will not match, right? And so this is essentially free money for you. It's a dollar for dollar. You're getting 100% return. So that is essentially free money, and you want to take advantage of this if your employer matches it, right? At least all the way until they match. Sometimes you'll see like different variances of it, um, like one example is they'll say, okay, we'll match the first 3% of your salary, dollar for dollar, but anything if you pass that, we'll match 50% up to 6%, right? Hope that makes sense. So anything past from 3 to 6% of your salary, they will give you 50 cents on the dollar. So not essentially 100% match, but it's still free money at the end of the day. So you should always match when you contribute to your 401ks. Another pro is that there are high annual contribution limits. It's 19,500 if you're under 50 and 25,500 if you're over 50. And it's just because that's kind of like a catch-up bonus if you're closer to retirement if you're 50, right? As opposed to if you're under 50. So that's why that's differences there. Another pro is that contributions lower your taxable income. If you make contributions to your retirement account, that means that come tax time, when you have to file your taxes, you can essentially decrease the amount of income that you've earned that year because you've contributed to your 401k. The last one is that eligibility is not limited by income, right? So as long as your employer offers you this 401k option, then there is no limits, right? You could earn, doesn't matter if you earn 60,000 a year, it doesn't matter if you earn $1 million a year, right? There's no limits on that, okay? So the cons are there's usually a very limited investment selection, right? So when you select your 401k, they're gonna ask you, okay, so do you wanna invest in like target dates, which are essentially you pick the retirement date closest to when you think you'll retire, and then they'll throw the funds into that fund, and then it has the appropriate risk level. The other con is that typically there are account fees, right? Because someone has to manage this portfolio for you. Because what it is, a 401k is essentially an investment account. You're putting money into this account, and then someone is managing this investment for you. So whether they're putting that money in the stock market, if you were trying to be aggressive, maybe they'll put 60% of your contributions in the stock market, and then 40% in something safer like the bonds, which are low risk versions of stocks, right? It just really depends on that. But at the end, someone has to manage that, and it's usually why there's like account fees associated with that. At 72, you're required to take distributions, though I know with this recent pandemic that's happened, Trump recently passed with the 2 trillion stimulus act that is no longer the case. But usually there are required minimum distributions starting at age 72. And there's also early withdrawal fees. So if whatever money you put into this account, you cannot take it out without having to pay a penalty on that money. So it's usually about 10% of whatever you withdraw. And then you have to pay taxes on that too. Okay. So next is the IRA. Let's look at some pros and cons of that. The pros are that it's tax-free growth. So if you put money into this, it's gonna grow tax-free. The tax deductions are these are for traditional IRAs only. And like I said, there's the difference between a traditional IRA and the other flavor, which is the Roth IRA. You could count the contributions as tax deductions on your tax statement come April. But this applies only to traditional. Probably the biggest perk of IRAs is that you can withdraw your contributions penalty free anytime. So penalty and tax free. That's the word I'm missing there. You can withdraw your contributions tax free and penalty free. Okay. Now, so not money that you've earned on interest, but let's say you've been contributing to your IRA for 10 years and you've managed to build a little nest egg of, I don't know, $20,000. You can withdraw that money and you won't have to pay taxes on it and you won't get penalized on it, right? So that's kind of like an investment vehicle that you could kind of use that money to make a purchase, whether that be a house or a business. Like I said, those assets that you're trying to acquire, you can use this as a tool. Of course, it's not advised because this is essentially retirement money, but I'm saying like this is a tool that you can use to fund that, right? Let's look at some of the cons for this. Contribution limit for this is substantially lower as compared to the 401k, right? That limit is $6,000 for individuals under 50, I think, and I think 7,000 if you're over 50. One thing I forgot to point out is that there are penalties for traditional Roth IRAs. So the pros, the bullet point number 3 here, yeah, Roth IRA only. So that's one distinction I really want to make clear. If you have a Roth IRA, then you can withdraw those tax-free, penalty-free. But if you have a traditional one, then that's when you'll face that penalty.